The US real estate industry is in deep trouble in July 2022. Hi everyone, this is Nir with Financial Whale, and today I want to talk about what's going on in the real estate market and what kind of information you want to pay attention to. I will start the video with a quote that says, "Winter always follows summer." So 2021 has been really a summer year for real estate assets, but today in July 2022, all the data we look at suggest that the winter is about to come for the US housing market. In the video, we are going to cover a few main topics. We are going to talk about why home buyers are canceling deals at the highest rate since the beginning of the pandemic. We will talk about the real estate firms across all sectors that are laying off hundreds of employees as the housing market cool down. And by the end of the video, I'm going to talk about what stocks I put my eye on, and maybe you want to put them in your watch list as well and follow them in the near future. Of course, it's not a financial advice and you should do your own research. Thanks so much for joining us, guys. And with that being said, let's get right into it. Let's begin, folks, with this tweet from Redfin. They tweeted it yesterday that about nearly 60,000 home sales fell through in June, equal to about 15% of all transactions. That's the highest percentage since the pandemic began. Some home buyers are canceling deals because they have room to negotiate, while others are priced out due to high mortgage rate. So a lot of people who got into home buying contract in the months of April and May, and their close of escrow was supposed to be in June, are deciding to back out of the deal and cancel the contract. I assume that a lot of these buyers are seeing what's going on in the market right now. They can see that the inventory is surging, they can see massive price cut, and they choose to take advantage of this and actually negotiate for themselves a better deal. This post from Instagram that I wanted to show you guys from Stock Sharks shows us that in Toronto, June home sales sinks about 41% as rate sidelines more buyers. Of course, in the channel, we're focusing mainly on the US housing market, but the reason I bring this post to your attention is because, first of all, Canada is not that far, and it can imply about what's about to happen in the real estate industry in America. Also, guys, let's not forget the Central Bank of Canada has been a little bit more aggressive in raising rates than the Fed, but we all know that by the end of the month, the Fed is about to raise rates again, and this implies that there is more pain to come to the real estate industry. This article argues that June's job report revealed impact of layoffs on the real estate industry. A few things I wanted to point in the article. In mid-June, Seattle-based real estate company Redfin, which we mentioned earlier, said it was laying off 8% of its workforce in response to a decline in home buyer demand. And take a look at, guys, what the Redfin CEOs tell us. We could be facing years, not months, of fewer home sales. Now, when I hear something like that from a CEO of Redfin, which is a person that exposed to all the data that is happening currently, not like the official data that the government tells us, and they tell it to us only 1 month after it already happened. Another firm, New York-based brokerage Compass, announced 10% reduction of their workforce. Other companies announced series of layoffs, with the mortgage industry in particular hitting hard. Declining sales in new home construction appear to finally take a toll on home builder payroll. While construction jobs were up overall, hiring in residential building came to a virtual halt in June. Home builders and residential trade contractors employers have shed more than 4,000 jobs from May to June on a seasonally adjusted basis. So we can see this article from Reuters from July 1st suggests that the US housing holdups put thousands of jobs on the line. And just a quick look, US mortgage lenders, refinancing companies, and real estate brokers may lay off thousands of employees in the coming months as many Americans put off buying a home. So we can see, we start seeing those layoffs across all sectors related to real estate, and in the near future, it's going to get worse and worse. Another chart I wanted you guys to pay attention to is the chart that represent the monthly rent versus the monthly mortgage payment. The monthly mortgage payment represented by the orange line, and the monthly cost to rent represented by the blue line. These two things have usually a correlation between them, and it's substantially cheaper to own a home assuming you put 20% down compared to renting a home. Don't forget, guys, with owning a home comes a lot of liability, either if it's the maintenance of the house, the roof, the air condition, the landscaping, and of course you have insurance and property tax that are your liability as well. Now we can see that since the beginning of the year, the gap starts to close down. Now, if we will get to a point that it's actually cheaper in America to rent a home than to own a home, a lot of people will decide they don't want the liability of owning a home. And this is just another indicator that shows us that, guys, we are right now at the real estate inflection point, and all signs are already there. Home sales are falling, and we see a substantial decrease in the number of home buyers in the market. Now, we mostly think that home prices are about to decline due to raising interest rate, but in reality, we actually have a surge in inventory and massive price drops, which leading to a lower sales price. Now, it's not time to go all in on real estate, in my opinion, and of course, it's not a financial advice. What I do think you should do right now is, first thing, increase your savings. Save. Every dollar that you save today might give you a lot more purchasing power in the near future. Another thing you want to do is get yourself out of debt as much as you can, either if it's credit card loans, car loans, personal loans, you name it. Just get out of debt, because if you will minimize the debt you have right now, you will be able to qualify for better properties in the future. And above everything, the most important thing, in my opinion, you should do right now is get yourself educated, get yourself informed about what's happening in the market, keep track of the data, and in that way you will be able to capitalize on the upcoming opportunities. Now, guys, we got to the part in the video where we cover some stocks related to real estate that are in my watch list. Just what I want to point, I opened here the stocks heat map of the S&P 500 with the year-to-date performance, and we can see that the real estate sector is deep in red, but it's not so down substantially like tech stocks and retail stocks. So I do think that there is a lot more pain to come in the real estate sector, and I'm going to elaborate on that right now. I want to start our stocks lookout with a famous quote by Wayne Gretzky, which is a famous hockey player in Canada. I'm not into hockey and I don't really understand about it, but I do like this quote when he says, "I skate to where the puck is going to be and not where it has been." To make nice gains in the stock market or in any asset class, you want to put yourself ahead of the crowd, and you want to position yourself where you are doing things before the big crowd is flowing into them, and that way you will maximize your gains compared to the other people who are just riding on the wave while it's already happening. So the first stock, it's actually not a stock, it's an ETF that we're going to take a look at. It's the DRV, the Daily Real Estate Bear 3 times share. That's an inverse leveraged ETF. If you don't know what it means, I encourage you to get educated on that. But leverage, it means that for every 1% real estate is moving, this ETF will move about 3% in the opposite side. What it means, if real estate is about to crash, this ETF is about to go to the moon. Okay, and what I wanted to show you guys, just from a technical point of view, because we already mentioned all the data about the real estate market, we can see that this ETF has been on a bearish trend for long time, and I'm gonna zoom out soon and show you more. But we can see we created here this double bottom, and we can see a shift from bearish into bullish. How we can see that? Take a look. We have here double bottom that the market has hit twice and it wasn't able to go under. And we can see that since then we're creating higher highs, higher lows, and again higher highs and higher lows. Okay guys, one more thing, we can see that if we draw a neckline over here for the double top, we are sitting right about on the support, and this is the daily chart. You guys can see that if we zoom out a little bit, we can see that this DRV is very bearish for the past couple of years as real estate have gone up tremendously, and this is why I encourage you to follow it in your watch list. The next stock I want to talk about is called AMT, American Tower Corporation. This is actually one of the largest real estate company in America. They own real estate all around the world. They are worth right now roughly $116 billion, and they are in $13 billion in debt. What we can see here from a technical point of view, of course, now we're looking at the weekly chart. We can see that they have gone up substantially with the real estate boom we have seen in the past couple years. From a technical point of view, we can see that we created here new highs and again new highs by close to the end of the year, and since then we can see that we started to go down. In the past couple weeks we can see here a consolidation. It's a little unclear what's going on in the housing market, but we're going to see this going to the downside soon. We might get a little bit of relief rally before, I don't know, but I think the general direction will be down. Also, we can see that the gap is starting to close between the 50-day moving average and the 200-day moving average, and once we're gonna see the 200-day moving average, which is represented by the red line crossing the 50-day moving average, this is another indicator that we're shifting from a bullish trend to a bearish trend. Keep that in your watch list, guys, and take a look at it. Also, please feel free to leave a comment in the comment section below if there is any stock or a certain market you want me to cover in the upcoming video. Another stock I want to talk about, it's D.R. Horton, which is one of the largest home builders in America. Again, if we look at the weekly chart, let's go back a little bit to 2005-06, the peak of the last housing bubble. We can see that the stock was around $42 right now, and after the crash and the bubble pop, they reached to their bottom in November of 2008, and they reached about $4. Okay, that's about 90% decrease in the stock value. And now since then, take a look, guys, this is not a meme coin. Take a look how this graph has gone substantially. Here we can see the dip we had when the pandemic began. So this stock went up. We already see here some signs for bearishness, and we can see that from the top, which was by the end of last year around $108, right now we're sitting about $74 for the stock, and we can expect those to go down because once the Q2 earning reports gonna go out, and we do expect to have a earning recession for Q2 of 2022, and we do expect these companies to reduce their guidelines for the rest of the year. Again, also, if we look at the moving average, we can see we can expect a cross between the 50-day and the 200-day moving average, which will give us another indicator. Take a look at it, guys. Keep it in your watch list. There might be a serious downturn in the near future. And the last home builder I want you guys to put on your watch list, they are called Lennar. This is actually the second home builder in America, the second largest home builder in America. Again, pretty similar to DHI. We can see a big dip here in the COVID, and since then we can see a run up. We created here kind of triple top, and since then we are going down. We see here a little bit relief rally, and right now the stock is sitting at $78 when at the peak it was about $116. Again, if we gonna change it really quick to a weekly time frame, we can see that at the peak of the last bubble, Lennar got to $68, and by the bottom they reached about $9. Again, about 80% decrease in the stock price. Of course, it came with massive layoffs, and I do expect to see similar things in the next downturn of the housing market. If you find this video helpful so far, please hit that subscribe and like button. Maybe even share it with a few friends who are looking to buy a home right now and help them to get educated about the current situation in the market. Now, I just wanted to show you guys this tweet really quick from Market Rebellion. The White House is expecting new CPI data to be highly elevated. Tomorrow, the CPI numbers are coming. And even though commodities are pretty down in the past months, we still expect to see the CPI data going above what it was in May of 2022, which can tell us that we still haven't peaked with inflation, and the Federal Reserve is probably still need to keep raising rates to bring inflation down. If you're not familiar with what is CPI, CPI is basically the Consumer Price Index, which is get out every month by the Fed, and we can see that from May 2021 to May 2022, we see 8.6% increase, the largest 12% increase since the period ending in December 1981, and we do expect this number to come a little bit higher. Now, when we get a notice like that from the White House, it can tell us what we're expecting to see tomorrow. And in the upcoming videos, I'm going to cover everything about the supply of the money, the raise of rates by the Fed, and how it's going to affect the economy in general and not only the housing market. One more tweet I want you to see, guys, from Nick. I encourage you to follow him. But we have here a massive recession bubble warning. In 2022, that's the first year ever that we can see asset bubble, debt bubble, and inflation, all three combined at the same time. And we actually never had something like that in history, so we can compare to. But all these things are bubbled, and it's not a good sign, not for the economy, not for the stock market, and of course not for the housing market. In the upcoming videos, we're going to keep tracking stocks, and like I said, some videos with more macroeconomic lookout. We can see that the performance year to date of the S&P 500, a lot of stocks are substantially down from their highs. We have like huge companies like Amazon down 35%. Everyone basically got hit: the finance sector, the technology sector, the retail sector. When it's rain, everybody gets wet. Thank you so much, guys, for joining me to this video. If you hold it so far, I appreciate you taking the time and listening. I hope you get educated. Please feel free to leave in the comment section below if there is anything you want me to cover or expect me to cover in the future. And again, thanks so much for watching, and I'll see you guys on the next video.